Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst for ETF.com.
And I'm Jeff Benjamin, Wealth Management Editor for ETF.com.
This week, we're talking with David Sharp, Senior ETF Capital Markets Specialist at Vanguard. Dave, great to have you on the show.
Thanks, Sumit. It's great to be here. Thank you for having me.
Absolutely. So, Dave, Vanguard recently put out a thought leadership piece titled Understanding the Total Cost of ETF Ownership. I want to get into the specifics of that report, but before we do, why don't we have you tell us a little bit about yourself? I know you're an ETF capital market specialist at Vanguard. Can you tell us about your group and what role your team plays in the ETF ecosystem?
Yeah, absolutely. So I think, ETF capital markets is sometimes a group that's not well understood by many members of the market. And what we're really focused on is the trading and liquidity piece of the ETF story. I often like to lead with our mission statement to kind of give a review of how our team tries to impact our clients. And that mission statement is really to create the best experience for our clients when they're buying and selling our ETFs. And we do that a few ways directly. Specifically, we try to target really good relationships with the ETF ecosystem, members of that ETF ecosystem, which include the market makers, the authorized participants who come in and create and redeem, the listing exchanges where our ETFs trade. We also look at, from a daily operation standpoint, ensuring that our products are trading with tight spreads, trading with deep markets, are trading at appropriate premiums and discounts that we would expect. And we use that knowledge to work closely in-house to be advocates for our products, to really think about that liquidity lens and ensure that our products are well set up to trade really well in the market. And lastly, we're focused on just being a good ambassador for our ETFs, being able to put together thought leadership like the piece that you mentioned, bringing that to the masses to be able to review and see some of our thought leadership and connect with our clients directly to ensure that they have a good experience when they're trading.
So, Dave, the ETF landscape, it's evolved quite a bit over the past 20 years. In the early 2000s, it was common for ETFs in the same category to have relatively wide differences in expense ratios. 10, 20 basis points differences in expense ratios are pretty common. But competition has driven those differences down dramatically. And today, competing ETFs often have expense ratios within 1 to 2 basis points of each other. So are costs something that investors even need to think about in today's environment?
Yeah, I mean, we think that cost is still really important. It's been something that our firm has really talked about for close to 50 years now. And it's something that is, really at the root of the way that we try to bring products to market. We always have and we always will believe that expense ratios are really important for clients that have long-term investment goals. The impact of compounding returns simply can't be refuted. And Vanguard was founded off the principle of taking less, giving more to our clients in the return of their investments. Our founder, Jack Bogle, has a great quote. In investing, you don't get what you pay for, you get exactly what you didn't pay for. And we really believe that at the founding principles of the firm, the way that we're structured as a company owned by our clients, that we give the best chance for our clients to have that success. We've never wavered from that belief. And after decades of proven results, well, the Vanguard effect is alive and well. So we are not surprised to see our competition continue to come fight us on cost as we see that low cost migration of client assets going towards that lower cost investment. And, where we compete directly, that Vanguard effect or Bogle effect, as some will say, is sometimes at its greatest. So we really think that cost is still something the client should be really thoughtful of. It is a motivating factor on choosing a particular product over competition. And we welcome that competition because it creates a better outcome for all clients, even those that don't choose us as an issuer.
So, Dave, I want to stick with expense ratios. Most investors, they're accustomed to looking at ETF expense ratios as the primary source of costs. Can you talk a bit about what the expense ratio measures and how it's evolved over the past 2 or 3 decades?
Yeah, so, I see the expense ratio put in simplest terms as really the cost to run an ETF or a fund. Everything from accounting costs, auditing costs, the cost of custody of the ETFs, even the salaries and wages of the folks that manage the portfolio can be considered part of the expenses of the ETF. And it's usually the most important component of the total cost story that we've talked about in this brochure and in other locations. Only when the life expectancy on someone's balance sheet is really short is its impact not felt as greatly. So if you're only going to be in a product for a couple days, the expense ratio might have less of an impact. But for clients that are buy and hold, that are going to hold that for a period of time, those expense ratios become a really important factor. And since ETFs are created or redeemed in kind, where we see, at times for most creation, if a new product, if an ETF is being created, the authorized participant will deliver the underlying securities to the ETF, and when we redeem, we deliver the instant kind securities out. There's cost savings even from a portfolio management standpoint, which are passed on with lower costs in the ETF wrapper. So cost just becomes a really important factor. And, one case study that we ran and we've showcased in that brochure is just looking at even the most liquid ETF in the market that has sub basis point bid-ask spreads, which we'll talk more about spreads in a moment, that due to the very low cost of a cost competitor from Vanguard, it only takes 17 days for you to break even in a lower cost ETF, 17 calendar days. So if you're holding that product for more than 3 weeks, the impact of those lower expense ratio really help to create a better investment for a client's portfolio. And that's why we really are focused and always been lightning focused on the expense ratio.
Yeah, Dave, speaking of expense ratio and bid-ask spreads, let's dig a little bit more into that. Unlike traditional mutual funds, which trade at a fund's net asset value, ETFs trade at market prices with different prices depending on whether an investor is buying or selling, and the difference between those prices is the bid-ask spread, as you know. Can you talk about what goes into determining the bid-ask spread and how they contribute to investors' outcomes?
Yeah, absolutely. We're entering my wheelhouse now in the ETF capital markets. There might be no metric that we care about more on our team than the bid-ask spread of our ETFs. And it's arguably the most important differentiator of mutual funds and ETFs when you think about cost and think about the impact of investing. Certainly the ETF gives you that opportunity, that trading flexibility throughout the day, but there is a cost to access that liquidity, and that is the bid-ask spread. It's an explicit cost that a client pays to buy and sell their ETFs, and it's the cost that really is charged by the market makers for providing that liquidity in the ETFs. I heard a market maker concisely describe their role as they provide liquidity and then they have to offset their risk. Of course, the complications that they each go through to complete both of those goals are much greater than those two bullet points, but that's really at the heart of what they are thinking about. So the most important metrics that will usually lead to an ETF spread are really turnover and volatility. If a product turns over a lot, the market maker is playing matchmaker in the market, who is buying from one client, selling to another, can have confidence that if they do buy from a seller and quickly turn that around to a buyer, they don't carry a lot of risk on their book that the market could move during that time period. But if a product has lower turnover, we can see it trade wider, since the market maker does take on additional risk to have the market possibly move from the time that they can turn that over from where they bought it from one client and are able to sell it to another. So a market maker often will set a spread a bit wider to protect themselves on that lower turnover product. Volatility, as I mentioned, is the other really important metric here, because if the market is moving fast, even the highest turnover products can see spreads widen. Since the market maker has heightened risk, the trade-off of, trade a product at a profit, it's tougher for them in quick moving markets to be able to achieve that. The spread is a way to protect themselves, and they can bid for it for a price that is lower than where they offer it. In the time that they might be able to sell that on the offer and it moves down, they can hopefully get out of that risk at profit or at worst break even. So what we do see sometimes is kind of the interesting element that even if a product is low turnover but has low volatility, you can still see it trade with tight spreads, like an ultra short bond product with low duration. If you don't think the market is going to move that much, even if it has lower turnover, the market maker can consider keeping those spreads tighter. So it is really a metric for what I would consider the risk premium for the market maker to provide that liquidity to the market. And the way that our team really tries to ensure that our products trade with the tightest spread is really being able to work closely with our trading partners to make sure that we're doing everything that we can to help mitigate their risk when trading the products. Helping them understand how to price our products with greater precision allows them to trade the products with less risk and less cost to the client. We work closely with the exchanges and lead market makers on incentives to ensure that they're there to step up for that liquidity. And lastly, we work closely with our product team to ensure when we bring a product to market, we're being really thoughtful about product design to create the cheapest products to hold with expense ratio, but also the cheapest products to trade with low bid-ask spreads.
So Dave, both expense ratios and spreads are explicit costs, but they're a little bit different, right? Expense ratios, they're an ongoing cost and they persist year after year, while bid-ask spreads occur during a transaction when an investor buys or sells. So given that, how should investors think about the ways these costs contribute to investment outcomes over time? For long-term investors, should they weigh the importance of expense ratios and spreads differently? And is it different for short-term traders?
Yeah, I mean, it's a great question. And as you noted, there are often factors to consider when reviewing the total cost. Questions that you have to ask include how many times do you plan to trade? How many times are you going to do a round trip within a year? How long do you plan to hold an investment on your books? A lot of these questions will play into, where is the break even calculation? When are you going to have a cheaper cost in a product due to the lower expense ratio relative to the cost that you had to pay to get in and later out of that product? The expense ratio is an enduring cost. So if you plan to be a buyer and buy and hold that for a long period of time, there's no bigger factor to what your outcome is going to be than that expense ratio, because it is not something that you will have to pay explicitly each time. It's inherent in the cost of holding that fund. Where if you were turning over security with greater frequency, if you were moving that ETF in and out of a portfolio with more frequent rebalancing, you do have to start to think a little bit more about spreads, because naturally there, as you are considering those spreads, you're going to be impacted by them by more round trip trades. So we often will look at in considerations when we're talking to clients, if you plan to do 4 round trip trades throughout the year, multiply your bid-ask spread by 4 and add the expense ratio, and that's your total cost. It's not often as simple as just saying it's the expense ratio plus the bid-ask spread. And as we'll talk more about, there's other factors as well, but that's often how total cost of ownership is simplified. We think it's important to learn a little bit more about the client's outcome, what their plans are with that ETF investment, and be able to give them better guidance on, what products and, how to trade those products as we, go through some of those considerations.
Good stuff, Dave. Let's go a little bit deeper on this with talking about net asset value and how ETFs can trade at a discount or a premium to the net asset value, which is something that you discussed in the paper. As we talked about earlier, ETFs trade at market-determined prices, which often are above or below the underlying net asset value of a portfolio. But how should investors think about premiums and discounts?
Yeah, I think, after bid-ask spreads, probably the next biggest, factor that the ETF capital markets team looks at is premium and discount. It's a very important metric, and it's something that isn't often well understood by clients. And we've been trying to tell that message to help them understand it and not be concerned about it, but really just be able to look at it and be able to think about it a little bit more, because it does become a factor. And when we think about what premium discount is, it's really the cost above or below the perceived market value of the underlying securities. Where is the ETF trading from a market value relative to its underlying holdings? And the good news is, with the open-ended nature of ETFs, where you can create and redeem at pretty much any time throughout the day for most issuers, that ability to create more shares to meet the demand really helps to keep market prices in line with the underlying value. If the price gets too rich, then a market maker or authorized participant can come in and create additional shares available for the market. That helps to keep it in line. Same thing on the redemption side. If there's heavy selling, then the market maker can buy additional shares of the ETF and come in and redeem it for the underlying securities in what we call the arbitrage mechanism within the creation and redemption mechanism. It's allowing the market maker to take a few pennies on either side to keep that product in line. But it still leads sometimes to, certain premiums and discounts that might be more relevant in one product type versus another. Domestic equity with great precision throughout the trading day, where it's all trading the same time the ETFs are. You know what the cost of the 500 index is at any point in time. You won't usually see big premiums and discounts enter that type of product. But as you go into international equity, where those bands between what the creation cost and redemption value are much greater, then inherently you could see greater premium and discount volatility. Also in bonds, many bond ETFs are bid side NAV, meaning that the net asset value of the fund is based solely off the bid of the underlying basket and not the midpoint where you see more frequently with equity products. So this leads to inherent premiums in the product. For most products that are bid side, you will usually see that they are trading above that bid in the market and have a premium in that product. Again, we wouldn't say to be concerned about it, but what we like to talk about is just the stability of those premiums and discounts. If you were to buy a ETF at a 10 basis point premium, but you later sell that for a 10 basis point premium, you didn't have any impact to your investment outcome. And that's what we want to see. What we try to avoid and what we try to affect is that a client doesn't come in and buy at a 10 basis point premium, but sell at a 10 basis point discount, because that would experience a 20 basis point drag on their overall performance. And there are a lot of factors that go into a premium discount of security, but sentiment is the biggest factor. So it's really important for clients in times of high volatility just to be able to understand what premiums and discounts are available in the market and be thoughtful if it's a long-term investment. Sometimes those volatile times where there is a little bit more volatility in premium discount won't be the best times to trade. And it's just something for clients to think a little bit more about.
How about tracking error and excess returns, Dave? We typically talk about tracking error in the context of index strategies. The lower the tracking error, the better it is for investors. But it's easy for investors to confuse these concepts of tracking error and excess returns. Can you help our listeners better understand them? Why are they important, and why do they matter to ETF investors?
Yeah, I think, when you think of tracking error, I think almost everybody immediately goes to the thought that tracking error is just how well over time an ETF's net asset value tracks the value of the underlying index. That's actually what we would consider excess returns. And unlike those comparative returns over time that'll often smooth out and show, extremely close outcomes between a fund's performance and its benchmark, tracking error actually looks a little bit closer to the volatility of those movements on a day-to-day basis. And that's what provides a really important metric for clients to think about when they're buying and selling. If you buy an index-linked product, you're expecting to receive the return of that index, less the expenses of the fund, which hopefully are low, that you would take out every day. You don't want to buy a product when it's higher than its benchmark in one day, just for that erode back to flat another day. So even though, excess return is a phrase that sounds like it's always positive, it really only stands to be positive if it is enduring over time. If you're consistently beating the benchmark, then that could lead to a positive outcome. But similar to premium discount stability, tracking error is really that stability from the net asset value to the index performance. And ensuring that you are, trading products with low tracking error will help to ensure that you're getting the expected returns. And that's something that, we have always focused on as a firm, being, famous for being an indexing shop. Tracking error is really paramount to us. It is how the way we judge our portfolio managers. It's not by cash flow. It's about their ability to track closely to that benchmark, and the slight excess return we might be able to receive to offset the expenses to more positively track the overall index. That's where we are trying to think about excess return and not have these volatile outcomes, which could lead to greater tracking error.
Let's talk a little bit about liquidity. Many of our listeners are financial advisors, as you know, managing substantial books of business in a lot of cases. There could be times when they're affecting large trades, such as maybe rebalancing across their client base. Can you talk about the multiple layers of ETF liquidity and how large trades fit into this dynamic? I mean, what can advisors do to ensure they're getting the best outcomes for their clients when managing large ETF trades?
Yeah, so this is one of those costs that I don't think, again, is often calculated into many folks' total cost of ownership equation. We've talked about the explicit costs that are there, like expense ratios and bid-ask spreads, which are usually pretty easy to calculate for most data vendors. We talked about costs which clients should be aware of that are harder to control, those related to premium and discount volatility volatility and tracking error. The fifth big component in this calculation of total cost is really that market impact. And this one comes with a little bit of an asterisk. And the footnote to that asterisk says it may apply. These costs are incurred really when a client is going to outsize the available liquid market in a product, resulting in a price higher than the ask for a buy or below the bid for a sale. And when you go up in size, it's more frequent that these might occur. There are many different factors related to that market impact cost, but liquidity still remains the main factor. And in the ETF, that story is really a story of two layers of liquidity that's available in the ETF, which makes it such a unique investment vehicle. First is that secondary market, trading between market participants in the open market, where 85% of the average ETF's volume will take place. The other side of it is really the primary market, where ETFs will be created or redeemed. And in times where there's heavy buy sentiment, you're likely to see creations. In times of a large transaction, you're likely to see that come in as a creation. The market maker, when they go to place that large trade, is able to think about what would be my cost to buy the underlying securities, deliver them to Vanguard to create those ETF shares, and be able to deliver those ETF shares to the client. So that liquidity available in the secondary market comes into their calculation first. How much, if I sell it to this client, can I buy back quickly in the market? And the second one is, what is going to be my impact to buy those underlying securities relative to where the ETF is trading right now? And again, this is something our team is focused on, making sure the market makers understand what it takes to create or what they're going to receive in a redemption. The more we can help them understand their risk to provide that liquidity and get out of that risk, the more depth that we can expect in the market and the more limited that cost will be. The last thing that I would just note is we're here to help. Your block desk is also there to help at your custodian, your high touch desk, because they can view into the depth of the market with a greater degree than you'd probably be available at the end client level. And furthermore, within an issuer's capital markets desk, such as what we have here at Vanguard, we're able to provide pre-trade analytics, real-time guidance, and even post-trade analytics to really serve as a best execution partner for the client and ensure that they get the best experience possible.
Dave, we've talked a lot about the contributors to costs for ETF investors. So I kind of want to bring it all together. We have this context that you've given us. How should advisors and investors ensure that they're getting the best outcomes? How should they weigh the factors against one another and evaluate different ETFs across those factors? For instance, are there different considerations for different strategies or different asset classes, like active versus passive or stocks versus bonds?
Yeah, so first off, I would encourage a little plug here to review that brochure that we mentioned, the Understanding the Total Cost of ETF Ownership. We'll expound upon some of the things that I talked about today and further lay out some of those stories so clients can really think about some of these considerations. And I'd be remiss not to give some special thanks to Ben Anderson and our ETF marketing team, who did a great job pulling that together, along with help from my colleague Patrick Hooper, myself, the whole capital markets team, to really put out a material that we really believe in and we think will help clients. Because at the end of the day, there are a lot of factors to consider. And you mentioned some of those. How long are you going to hold it? How often do you plan to trade it? How large is the trade? How easy or difficult is it to track a particular index? How liquid is the underlying? All of these are important questions for the client to think about. And each product has nuances to how much you might, expect for those impacts. Bond ETFs, for example, are more likely to trade with premiums, as we mentioned before. And it's okay. It's due to their design. So consider the stability in those products. International equity have more costs due to higher costs to settle securities. So they might trade with higher premiums than their domestic peers. And although active products can trade wider due to what is often considered a more dynamic hedge for the market maker trading in and out, if they're going to hold inventory over a couple days and that product could change its composition due to the active nature, they might have to add a little bit more cost to that. But there's also creative ways to mitigate against that and to, possibly deliver smaller basket sizes for that creation that allows you to manage that inventory more effectively, because the active products don't have an index that need a representative slice from every creation. So you can have a smaller size to bring that in and buy certain securities. And that's what we've seen, recently with our core bond and our core plus bond with very low creation unit sizes. We're able to deliver really strong liquidity right out of the gate. So, the last thing that I would just, reinforce again is that if there's any questions on our lineup, we'd encourage you to call. We want you to get the best outcome for the product of your choice, and there might be additional considerations that we might be able to highlight for you to ensure you get that best execution.
Hey, Dave, I want to wrap up with one question on the spot Bitcoin ETFs. It was obviously the biggest news in the ETF space this year. 11 ETFs launching January 10th. And Vanguard was one of the firms that came out and said, we're not letting those spot Bitcoin ETFs on our platform. What can you tell us anything about the strategy behind that? And maybe if Vanguard is second guessing any of those decisions?
Sure. Yeah. I think, there's two considerations really related to the Bitcoin ETF. One, as issuer, will Vanguard bring a Bitcoin ETF to the market is what a lot of my, peers and clients might ask. And we don't have plans to launch a Bitcoin ETF. We do have a very thoughtful and data-driven approach to building our lineup. We want to ensure that we offer products that have enduring investment merit. We fear crypto doesn't always fit that well into most clients' long-term investment goals due to its lack of intrinsic value. Our lineup is very concise relative to our closest competitors because we really want to make sure that we bring to market products that are going to improve client outcomes in a stable and consistent way. And we think we have the right building blocks in our ETF lineup today to achieve that goal for most investors. Furthermore, investors come to Vanguard because they know that we put our interests first, and that drives our approach to what we do and don't offer through our brokerage platform. It would be easy for us to simply allow investors to trade Bitcoin ETFs, but we're intently focused on serving the needs of our investor owners, and most of them are long-term buy and hold investors who don't see, crypto maybe fitting into their long-term plan. So, that really went into our consideration. It was really, we were, maybe bold in, not allowing those to be there, but it's really just sticks to our principles that we want our clients to have enduring long-term, goals that we can achieve through the products within our lineup.
Oh, fantastic. Dave, we're going to have to leave it there. You gave us a ton of great insight. Thanks so much for your time.
Yeah, thank you both. I appreciate being here. Thank you.
Listeners, I hope you enjoyed this episode. You can find this and all other Exchange Traded Fridays episodes on ETF.com or on any major podcast platform. See you next week.